Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Jack Otter. Coming up, we'll take a look at how GLP-1 drugs are expanding beyond weight loss. Could they become the drug for everything? And what did this week's big tech earnings tell us about the market ahead? We're breaking it all down. We begin with our expert panel on 3 things investors ought to be thinking about right now. On the Barron's Roundtable, my colleagues, Josh Schaefer, Tarifa Rivas, and Jack Howe. So, Josh, AI rules the world, and yet the Nasdaq is in a correction.
Yeah, the Nasdaq 100 entered a correction midweek, Jack. And so really what's been driving that has been chip stocks. If you look out at the week overall, the Nasdaq composite actually closed higher. That's because you had Microsoft have its best week since 1999, and you had Amazon have its best week since 2015, over a decade. So you had some strong tech earnings at the forefront, but there's really been so much chop under the surface. These chip stocks that we talked about a lot at the beginning of the year and through really the second quarter has completely unraveled that trade. That has been a momentum trade to start the year. That means that investors are chasing winners and just saying winners are going to keep winning. That completely fell on its face in July, actually led to a hedge fund manager, a Gen Z investor, mid-20s investor that had been way over levered. He got fully unwound. Situational awareness was the name of the hedge fund.
Ironically.
A little bit ironic in hindsight, but that was part of the action you saw in, say, a SanDisk, which was moving over 10% nearly every day this week, down 10, then all of a sudden up 25. So it's been very volatile in the chip space.
A total morality tale there, by the way. I mean, his stock picks were pretty good. Had he not levered up, he'd probably be fine. Instead, Ken Griffith from Citadel apparently bought most of that stuff at cents on the dollar. That's the real shark.
It's a good lesson, Jack, for people looking at those 2x leveraged ETFs.
Yeah.
So if you look at SanDisk in the month of July, SanDisk down about 40%. If you bought the 2x ETF, which, by the way, you're not supposed to hold for more than one day, but if you did, you were down 70% at the bottom in July. So again, those leverage ETFs, you really need to be careful, and they're not meant to be held for more.
Yeah, I'd be really careful as you never touch them, ever. All right, buying the dip obviously was a winning strategy for Ken. It's been a winning strategy for most investors for years. Is that trade over?
I don't think buying the dip is necessarily over. I think it's tread carefully right now. So when we're talking about the market being this volatile, you're seeing so many big swings. I think you can start maybe dipping your toes back into some of the chips at this point. I spoke to Stuart Kaiser. He's the head of trading over at Citi. He said if you were going to put $100 as your full investment, they're saying maybe put 25 in right now. Start nibbling some of that positioning. Again, the leverage has come out of the market. You have strong earnings in chips, but with the environment right now, don't buy it and think that it might not move a lot. You might still get a lot of movement in those names. That's why he said, 25 cents on the dollar, start nibbling, don't take a full bite.
A lot of movement also in the yield curve, steepening there. Was it something Kevin Warsh said? What was going on there?
I think it was what Kevin Warsh didn't say, maybe, Jack. I think the market at this point wants the Federal Reserve to be closer to hiking interest rates than it seems to be, or at least than Warsh is saying that it is. You had 3 dissents on the hold that they had this week. Warsh comes out, doesn't really say much about hiking. 30-year hits its highest level since 2007 and seems to keep heading higher. So I think that's the fight right now, is the market wants Warsh to be saying something a little bit different than he really is fully willing to admit.
Yeah, we'll talk about that more with Lisa Shallett. Teresa, earnings. Let's start with the happy news. Microsoft, as Josh predicted, did well.
Yes, as you mentioned, it did fantastic. And both Microsoft and Meta are spending approximately $1 zillion. So that's not the problem. The problem is that Microsoft did not increase its CapEx. And after all is said and done, and it spent all that money, it still had enough to buy back some shares, a little shy of $20 billion in free cash flow. By contrast, Meta keeps upping the ante. They haven't bought back shares in, I think, 3 quarters now, and they're almost cash flow negative. They have less than $1 billion remaining after they spend all this. So obviously the street doesn't like to see that. If you look at something like Amazon, as Josh mentioned, they're doing great too. They're spending $220 billion. They're cash flow negative. They're using debt to raise money. But AWS, their cloud business, is doing well enough that investors feel comfortable that demand is going to be there and help them continue to be profitable.
And the market is comfortable watching Jeff Bezos spend a lot of money. Yeah, Jack?
It's getting hard to say. Like if you tell me Microsoft went up or down 3% or 5% in a day, I would ask you what's going on with Microsoft. If you tell me about a 15% move, or you tell me in the case of Micron, down 18% over 2 days, then up 18% a day, the question is, what's going on with you, the investing public? Because it's starting to look like you can't decide whether you're, crazy fearful or crazy greedy on any given day. It's making it really hard to be like an individual stock picker or money manager right now.
So you don't think the future for a huge enterprise software company changed 15% in a day, huh?
I have my doubts.
All right, who needs all that software anyway, Jack, when you could just buy shares of Coca-Cola company?
really an extraordinary quarter. I would call it flawless, and this was a 5% move for that stock. We had the World Cup. It was, easy comparisons. There were also low expectations. Big Food hasn't been doing well, in part because of these GLP-1 drugs, which we're going to talk about later. But I would say a couple of things to point out about why Coke is clobbering Pepsi this year and beating the stock market. First of all, it's taking market share, especially in the fastest growing part of soft drinks, which is anything with the word zero in it. It's taking market share in cola, taking market share in lemon lime soda. Over the past decade also, there's been really a transformation at Coke. This used to be a company mostly in the business of bottling and selling soft drinks. Today, it's an asset-light company that leaves the truck fleets and the factories to everyone else, and it just collects fees. And investors really like that. It allows Coke to focus on its marketing. It's working well, and it's gotten the stock a higher multiple.
Sierra missed, won't say Pepsi, I guess. Talk about the price to earnings multiple on the stock, which exceeds that of NVIDIA. Great company, Coca-Cola, Warren Buffett loves it, but do I want to buy at this level?
26 times earnings for Coke. The dividend yield is down to 2.4%. So you could have Pepsi, which isn't doing nearly as well. It's only 16 times earnings. The case for Coke is, hey, it's no longer a soda company. Compare it to like a Marriott or some other asset-light company. I don't know. I'm a little skeptical about that case. It looks pricey.
Alrighty.